the LP demands private credit.
Mm-hmm.
For what we will call the 6 wonders of private credit, your absolute returns, your quarterly income, your predictable outcomes, your downside protection, your ability to diversify through 26 sub-strategies of private credit, and you have that shorter duration funds.
Welcome to Private Capital Call, the podcast with leaders in asset management, investing, and capital markets. I'm your host, Randy Schwimmer. This month, we are thrilled to welcome Jess Larsen, founder and CEO of Briarcliffe Credit Partners, a premier placement agency dedicated exclusively to private credit. Briarcliffe specializes in fundraising services for established private credit strategies, helping firms navigate the evolving investment landscape. With extensive experience in private credit and capital raising across private markets, Jess is a recognized industry expert. His insights on private credit trends are frequently cited in major financial media, making him a valuable voice in the field. He's also a great friend of ours at Churchill and The Lead Left and here at Private Capital Call. For the second time, Jess, thank you so much for joining us.
Thank you so much, Randy. It's a real honor to be here, not only coming back again. That's a real honor. Thank you so much.
Well, I think last time we had you, and it was probably in the written format that we used to do it a few years ago, maybe back in 2022, life was a lot different in the world than it is here, recording at the end of April of 2025. And maybe we can talk first about some of the pressing issues in private credit, in particular, the volatility in our current market, and particularly some of the risk-return dynamics that investors are looking at. And as you know, we started 2025 on a somewhat hopeful note. It seemed like the Fed had actually accomplished what they wanted to, a soft landing. Interest rates had kind of gotten down to a 2-ish% level. Same with inflation, or I guess inflation was down at that level. And the interest rates they'd gotten down by about 100 basis points to kind of a 4.5% level. And the economy was kind of chugging along, and all of a sudden now things have been thrown in disarray by current events from a tariff perspective. And I guess you travel maybe even more than I do, but you talk to LPs all the time. Your fundraising business exclusively focuses on private credit. Talk to us about how LPs are thinking about the current environment and what's going on in their heads.
Yes, the environment looks different. The environment looks different from the plan we had. I think the key word, what we're seeing right now, is uncertainty, is the lack of predictable outcome of where we are. Is our economy going up, down, stagnating, sideways? All of those are great questions that are a little difficult for most of us to answer at this given point. So I think for that particular reason, the LPs are taking a little bit of a different approach. Rather than having a directional approach, I feel that there's a bit more of an all-weather approach to how to build your private market portfolio, and in particular, how to build your private credit portfolio. And I must say, for someone like me who doesn't follow the stock market, I feel a lot less anxious than many other people. I think we are in a very great space, Randy, in the sense that we do not have to watch day-to-day pricing.
Yeah, and let's talk about that a little bit, because the concept of transparency of valuations in private capital is mistaken for true valuation. In other words, if we can't see it, then it must not be true. Or if we can't see it, there must be problems going on. And yet you pointed to one of the real strengths of private capital, which is the lack of correlation to what's going on. It seems in our conversations with LPs that this is something that's well understood and perhaps even more confirmed in the current environment. Is that what you're sensing as well?
It is exactly what we're sensing. I find, and I'm very pleased to say, that when we speak to LPs, which we obviously do on a daily basis, the LPs are not panicking. They're not pressing halt or pause, as we did during COVID. Different time, different black swan event, so to speak. We're certainly finding the LPs are still moving forward, and I feel that there's an even higher conviction of the private markets. It was almost like it's been confirmed this is where a lot of our capital needs to be in order to protect our underlying investors or pensioners or insurance. So I do feel that there is a confirmation of the private market, and in particularly the private credit side of it.
One of the things that has changed dramatically since the beginning of the year is the sense of the chance of a recession. And you see this both in terms of the, kind of market reads, but also the economists who are out there looking, and whether it's 20% chance, 30%, 50%, 70%. It does feel like this uncertainty that you pointed to is going to create hesitation on the part of businesses to invest. How should investors, given that, approach the risk return profile that they have had in private credit relative to what they should expect going forward?
From our conversation with LPs, and if I take that back a little bit, back in 2022, the return expectations for private credit was higher than it is now, which I thought was an interesting one. It has gone down a little bit. It used to be 14 to 16. We're now talking probably 10 to 12 to 13% net IRRs. So there has been a little bit more of an adjustment in your return expectation from LPs. Now, the current uncertainty and the current volatility we're seeing has probably less of an impact to where our returns expectations are. What we certainly see at Briarcliffe from all of our conversations with institutional LPs in the private credit is the way that they're building and approaching their portfolio construction will allow them to continue to have return expectation of, call it 10 to 12, 10 to 14% net IRRs. They're just approaching the portfolio construction a little different than they did in 2022 or in 2021.
And is that driven by the fact that interest rates have come down by 100 basis points, and then there's obviously some expectation that there will be further spread compression, or what's driving that?
I think it is driven mainly by the uncertainty. Now, we've been talking with LPs for a while about, do we expect a recession, or do we expect some kind of stagflation? Are we expecting the market or the economy to continue to grow? And I can't answer these questions. Now, if I look for an answer, I actually read your emails.
Thank you.
That's where I look for my answers. But what we are seeing is there's a little bit of lack of conviction on where the economy is going. That lack of conviction is only being exacerbated over the last couple of months. So what we're seeing is there is a more of a complement to what has been driven by mid-market direct lending. Mid-market direct lending will continue and will probably, hopefully, always be the core income component of a private credit portfolio. But what we have certainly seen within Briarcliffe is the interest and the money going into complementary strategies, and therefore building a portfolio that has a little bit more of an all-weather setup.
Yeah, I want to talk about that in a minute, but let's go to two of the issues that I'm sure you've heard too, given the fact that a recession seems more likely, whether it will happen or not. And my own view is that I think that we'll probably settle into a very slow growth, i.e. kind of 0 to 1% growth for the end of the year. That's hope. We'll see what happens. But given that, I think there are concerns about two things. One is defaults. And then the other thing, which is a little bit odd, but I'm still hearing this, is given all the capital that's in private credit, that there's concerns about spread compression. And again, in an environment where you're risk off, one would think that spreads would gap out, not compress. But I think they're looking at supply demand when they worry about that. But let's talk about defaults first, and then this supply demand issue that seems to be bedeviling investors.
I think it's healthy for an LP to ask the question, if we are having a more challenged economic environment, how will that translate into U.S. corporate profitability? If that's going to be impacted or put under stress at a certain level, will that have an impact, therefore, on default rates? And then the next question will then be, how will that impact my mid-market direct lending strategies? Now, I think what we have seen and what everybody has recognized is mid-market direct lending has proven itself immensely resilient. We've had some quite interesting markets in the last couple of years that you and I have often talked about over lunch, but COVID being one of them, and the current environment and another one. Mid-market direct lending, or direct lending as such, is very resilient. But I think it is healthy for an LP to ask himself, should I have exposure to more than EBITDA lending when it comes to private credit? Therefore, if in case there is a spike or a normalization in default rates, I'm still going to be okay, and I can still meet my return hurdle.
And what about too much money chasing too few deals?
Well, that is an interesting question. I heard that 5 years ago, and you and I still hear it today.
Yeah.
And we will hear it in 20 years when private credit is a $20 trillion industry, and we're only sitting at $2 to $3 trillion today.
Right.
I think we have a plenty of way to go before that becomes the meaning.
Well, particularly given what's happened now in the last 2 weeks, that the broadly syndicated market has effectively shut down. High yield bond market similarly. There's signs of some green shoots, but clearly the private capital market is there to provide opportunities for borrowers when the public markets are shut down. So I think I'm hearing less worry about spread compression. In fact, there's an expectation if this continues, and certainly this uncertainty that you mentioned, which is that's the one word that we could describe what's going on, I think that would be it. Given that I think that the amount of opportunities for direct lending is probably going to be significantly higher. And we're certainly seeing that in our own business. But talking about a little bit the fundraising environment, because this is that issue of supply demand, you had said to me an amazing statistic that beginning of the year when we first chatted, that there were 1,100 private credit managers raising money so far this year. Is that accurate? Did I get that number right?
It is correct that there's over 1,000 managers registered for fundraising. Does that mean there's 1,000? That means there are more than 1,000. Because every single manager, more or less nowadays, are pre-marketing. As a matter of fact, as a private credit manager, you should never be out of market. But registered for fundraising is 1,000. Right. So if you're an LP, you can probably imagine the congestion they have on their emails and their phone calls. You got 1,000 private credit GPs trying to sell their funds. And very interesting part of private credit is the outcome is very predictable for private credit performance, i.e. the range of outcome is also very narrow compared to other asset classes such as private equity for that matter. A lot of the private credit strategies will at some point or at some level look the same. Right? So how do you differentiate when you call out with you have what you believe is a strong risk-adjusted returns and you would like to talk about it with an LP, but they are still getting another 1,099 calls.
And I assume a lot of these now are what you referred to earlier as some of the emerging strategies, asset-backed finance and others that are coming into the picture, correct? Not just core direct lending.
Yes, and we're touching on a point which I always find very interesting when we talk about emerging strategies and what are emerging strategies. I mean, one could be contrarian and say direct lending is emerging. 2,500 pre-Christ, which back in Mesopotamian times, we had the first recorded asset-based loan.
Okay.
That we actually going back so many thousands of years. So one could argue that direct lending is the emerging asset class. It is a dominating asset class when it comes to dollars, but it's not a new strategy.
2,500 BC.
Yes.
Okay, that was before the lead left was published.
Just before.
Yeah,
I think it was the year before launch. Yes.
Yeah, we started.
You look great, by the way.
Thank you. So this concept of having this many managers out there begs the question, if you are an LP and you talk to the LPs all the time, how do you pick?
Yes.
What makes a GP a winner versus a loser?
That is a question that we have spent a lot of time on. We spent a lot of time on it at Briarcliffe, and one of the things that we have been doing is we've gone back since day one of when we launched the firm and the mandates that we're looking at. Now, put that in context. We are very fortunate to be the only dedicated private credit fundraiser as an agent. So we also have the luxury of being able to only pick 2% of what we meet. Right? So we see over 200 private credit GPs a year that needs help with fundraising. We pick 2%.
Wow.
Now, one would think we would be pretty good at picking the best ones. So in theory, all of our mandates should be blockbusters when it comes to fundraising. And to a certain point, we like to think they're all successful, but some are more successful than others. So we sat down as a team and we said, what makes a fundraising successful? How can we pick 8 managers? And some do a little bit better than the others. So what is the differentiator? So we looked at different parameters. We looked at actually 7 different parameters, such as the brand. Now, the size of the fund number. Are we on number 12 or are we number 2 or what? Where are we? The performance. We looked at the investment process. We looked at the operational platform. And we looked at fees and terms. And we actually looked at 2 more, which was strategy and demand. And we looked at the manager's ability to pitch and communicate. And we learned that from all of these, you can really put them in two categories. One of them is these parameters basically allowed you to be invited to the party. And that is the brand, the size, the fund number, the performance, the investment process, operational platform, and fees. All of those do not win you the mandate, but it allows you to be invited into pitch. Now, so the question is, what really makes you win? And those are really two things. One is your strategy, whether that's trade finance or whether it is NAV lending or mid-market direct lending. If your LP has no demand for that strategy, you have an issue. You need to have an alignment of demand and your strategy on offer. Secondly, and this is what actually took us by surprise, the manager's ability to communicate with an LP, that is the key, really the biggest differentiator of winning and losing. Considering everything else is equal, what really sets you apart is your ability to, when you sit down with an LP, in a concise manner explain how your strategy adds value to the LP and how you're different. And every follow-up is concise, it's on time, it's LP friendly, and that ability really sets you apart.
So that's an amazing point. And you've said this to me before, that alpha in private credit is not performance, it's actually communication, which I keep quoting to anybody who will listen. And I think it's...
Did you also quote the copyright?
Yeah, I also mentioned who it is that is doing this communication quite well, and you do this with LPs, which is terrific. And in fact, you, I think, have done a great job in having dinners and conferences and cocktail parties with these LPs and actually asking them directly, what is it that you're looking for? What is it that you're worrying about? What is it you're thinking about? And I think we could all learn a lesson as a GP as to listening to your client. What is it that they're looking for, particularly in this current environment? And I know that when I travel, I make it a point of, when I'm talking to our clients and our friends out there, is first question, what's on your mind? What are you dealing with? What are you thinking about? Now, the answer is surprisingly universal, and it goes to how we started this conversation in terms of this uncertainty of what's going on. But once they unburden that, then they go into some of the challenges that they're having in this environment where so much is coming at them so quickly that they want to know that their managers are doing some of that thinking for them.
Exactly, yes. Not only that, but also you need to be able to communicate it. I mean, we have worked with we are privileged at Briarcliffe that we get the chance to work with some of the absolute smartest GPs in the industry. But not everyone has the equal ability to actually communicate how they're different, what they do exactly in an understandable manner. Private credit can be complex, it can be sophisticated, but it can also be very simple if you explain it in the right manner.
And what do you think the biggest misunderstanding is about private credit?
Well, I can tell you what the biggest misunderstanding is in a pitch environment when the GP meets the LP for the first time.
Yeah, that's great.
Yeah. And this is almost universal. And that is the GP has almost like an informational advantage of his own or her own strategy. And the eagerness of explaining all of that amazing, sophisticated competence and team and everything to the LP, that they're almost an informational overload. And sometimes a lot of that information is not actually what the LP is looking for. Sometimes they are looking for a little bit of a different thing. So there is the old saying of, listening rather than talking.
Yeah.
And maybe it is a little bit of saying, what do you like to hear about our strategy and how can I concisely explain it and not over-explain and not informational dump? Because we all find every GP will obviously be very confident in their own abilities to deliver and therefore feel that there's a lot to share.
That issue of listening is so important. And speaking to someone who had talked to an investor about a recent fundraising effort, the search for a manager that they had been doing. We were not involved. And they said, they had interviewed a dozen or so managers and said that really in all of the meetings, none of them had asked any questions, which boggled my mind because, we go in asking questions because we know that we don't know everything and we certainly don't know what's on their minds until we ask them.
Yeah.
So it's a great reminder, particularly in this environment, since things change so frequently, right? The frequency of change, the velocity of change is such that guaranteed since the last conversation you had with them that something may have changed in their mindset. What do you think this issue of, and I go back a little bit to the risk reward dynamic that we're currently facing.
Mm-hmm.
What is it that's behind that? Because to every investor has a different, for example, liquidity demand. Every investor has a certain deployment demand.
Mm-hmm.
Every investor has a certain risk parameter. Every investor has a certain allocation concern, right? How much, in order to dedicate more capital right now to direct lending, they may have to take it from, for example, private equity, or they may have to take it from real estate or something else, or another private credit strategy. What are some of the things that they're worrying about?
I'm so happy you asked me that question, because it's something that we have thought about often. Is when we speak to an investor and they say to us, as an example, we're looking for an asset-based lender. That's interesting to know, but the real question is, what is the purpose you're trying to achieve with an asset-based lender? You really want to dig a little deeper, not just saying, yes, we have some great asset-based lender, but you really need to understand why. What is the purpose you're trying to fulfill? Now, and this is where we learned a lot. So, and we have kind of taken that information and listened to what people are telling us, and then we have translated that into what we think and we believe is portfolio construction. And if I can briefly try to walk you through it. So if you visually think of in the center of the circle, that is your core income. One of the most beautiful things with private credit, particularly direct lending, is your quarterly income payment. That's your core of your private credit. And that core will continue to be there. And that is called mid-market direct lending. And we don't see that's changing. Now, you then have 4 complementary categories hugging that circle in the middle. And one of them is what we would define as portfolio hedging. If we are having a recession, if things are turning south, now if I have distressed for control or distressed or special situations or NPLs, I have a little bit of hedging versus my direct lending. So that's one. The other thing is, I just want to have more secure downside protection. And how do I do that is I can get an asset-based lender where if something goes wrong, the asset-based lender can go and pick up physically that asset that the loan is attached to. It is in a bankruptcy remote vehicle, and I feel happy with that. Now, the other one is I need some returns that are uncorrelated to U.S. corporate EBITDA. And what do we mean by that? We mean like specialty finance, litigation, NAV lending, and trade finance. And then lastly, what we also hear from LPs is like, well, if there's a concern that spreads are compressing, may or may not be correct, how do I get some performance enhancement? So I need a bucket that gives me a little bit higher performances. And you can get that by specialty lenders. You can get that by capital solutions, which is something that's growing very fast at the moment. You can even get it with secondaries. You can get great loans you buy with a little bit of a discount, and there's a pickup there. So when you try to put all that together in one visual portfolio, you're looking at your core income in the middle. You're looking at your portfolio hedging. You're looking at your downside risk. And you look at your uncorrelated returns. And you're looking at your performance enhancers.
So hedging, let's go back to that. Is that rate hedge, or how do you think about it?
It really is hedging your core income component. And if you think about it, the core income is really dependent on the health of U.S. corporates, U.S. corporates' profits. And if that is taking a challenging turn, you want to have something that can hedge that. And that could be distress for control or distressed special situations or even NPLs. So if the economy is going south, if we're going to have an increase in bankruptcy and defaults, that is one way of playing it.
Got it. So one of the things that's a bit of a challenge in the current environment is that given how tariffs are unfolding or not unfolding, but, theoretically will unfold, the U.S. versus global construct becomes something that investors are going to take a serious look at.
Correct.
Is there a safe haven? Is there a place to go that's, a nice little island that we don't have to worry about these things?
Well, not sure if we have any safe havens in this environment. But one of the things that we have certainly spoken a lot with our LPs, with our U.S. and Canadian LPs, is the increasing interest in the European market. maybe it's time for us to look outside of the US capital markets. Is Europe creating more opportunities, either from a distressed angle or even from a growth angle? There certainly seems to be more volatility, less predictability in the European community, and maybe this is a good time to play that. So yes, we have for the first time in our histories, we're representing two European strategies, because allowing the US to actually access the European market. We have one that plays on growth, and we have one that plays on distressed. So depending on your directional view.
Okay. And I think, we're fortunate enough to have both the US and European strategy under our Nuveen private capital business with Churchill and Arcmont. But one of the things that definitely feels like an appropriate balance is that Europe, just based on what's going on, feels like their focus particularly on the leveraged finance market, where banks have historically been a little bit stronger, but that direct lending market has also been less competitive, with more large providers dominating, as opposed to the US, where it tends to be a little bit more diverse. And I think that potentially could continue to be the case there. And you could, based on what you're saying, you could continue to see more European issuance, I would think, in this environment.
I think you're right, Randy. Absolutely. I think there's so many opportunities and there's so much going on in Europe. There are ways to make money. And I think LPs are beginning to realize that.
You touched upon portfolio construction. One of the challenges about that we saw in COVID, and we're seeing again now, is the impact of supply chain challenges, right? And we've been through it before, so we tend to focus more on the service side of industries rather than the manufacturing side, commercial and industrial versus the consumer. And I think that stance has served us well over the last 5 years. I think it will continue, particularly in this current instance. Companies that are less sensitive to these cross-border issues that we're having, but frankly also more U.S.-centric in general. And that has, at least for the U.S.-centric businesses, proven out pretty well. And, we're keeping our fingers crossed, but it does feel like I'm looking at our pipeline of transactions that tend to be more service-oriented, things like plumbing services, electrical supply, and things like that, where you have very low manufacturing components, high free cash flows, relatively strong margins, and therefore, in this current environment, probably similar to what we saw during COVID, that these businesses are going to continue to do well. And certainly from a private equity perspective, businesses that have continued to demand relatively high purchase price multiples, interestingly. I don't know if you've seen that in some of the strategies that you're all looking at.
We've seen it in the sentiment of LPs. And I think there's always more than one way of playing a situation. But yes, you're right. There are LPs who like the manager that can give them a more defensive approach. And then there are other LPs who like to address it head on, such as in COVID. We definitely had supply chain issues. And one of the ways that we offered our LPs to play that was through shipping. Some would shy away because it doesn't necessarily be your defensive mode of avoiding the supply chain issues. There are others that are saying there are issues, let's put money to it and see if we can capitalize on it. So I feel that we see both sides from an LP perspective. Some people would love the strategy that you are formulating, where let's keep you out of trouble. And then if you want trouble, find that elsewhere in your portfolio. And we try to offer both.
So let's wrap up by looking at the future, because I always admire the way that you think about the themes that we're going through and some of the dynamics that we'll experience as we go through the rest of the year. When we look back on 2025, so you and I are sitting here next year, what will we see as what will have happened? Look ahead and tell us a little bit about 2025 as you see it.
Yes, we have a strong view that when you and I are sitting here, or when we're having a catch-up lunch and you are schooling me again about the interest rate and the economy, or educating me rather, we will look back at 2025 of the inflection year of fundraising for private credit. It is so interesting that for the last 4 years, every newspaper, every conversation of private credit is centered around the golden age of private credit. And I agree. We were one of the first to shout from the rooftop that private credit is not a $2-3 trillion asset class. It is a $20, $30, $40 trillion asset class. However, when we then read the dire stats of actual fundraising, it's been going down since 21. 21 was so far the height, and then 22 went down, 23, 24 went down. We believe 2025 is going to be the actual start of a very long-term, call it run for private credit, where we're really going to see growth. And it's going to be so substantial that in 30 years, when you and I have another conversation about private credit, the growth of private credit will dwarf what we have seen in private equity since the 90s. We're talking about the heydays of private equity. Those days are behind us. And I'm sorry to say, we will have a slowing growth of private equity. The future, that's private credit. And there's no doubt.
And the drive is retail and wealth, you're saying?
Well, it is wonderful for us to see the retail market because we all know the retail market is larger than the institutional. However, what we are thinking, what we believe are the drivers here are three things. The banks will continue to be regulated. Now, we saw it in 23 how regional banks faltered. We know and we have learned, and SEC has been out publicly saying this, the leverage of the bank versus the private credit managers is much safer with private credit managers. There's on average 1-to-1 leverage on private credit. The banks, we all know, is a whole different leverage story. Now, the private credit funds are intelligently set up from a duration. So you're really looking at 7-year funds, whereas a bank, to a certain extent, you're lending out overnight deposits. And you can have a run of a bank, as we saw in 2023.
Yep.
We saw it. We see how detrimental it can be, despite the fact the underlying loans may be very, very healthy. So the market is much more stable as we continue to regulate the banks for loans and putting that into the private credit market. We are seeing private equity. That's one. Secondly, we're finally seeing private equity delivering net positive distributions. We need capital in hands of the LPs in order to get it allocated. We also know, you and I, and most of the market will know this, private equity is going to deliver lower and more volatile returns than they have in the past. That is a fact of the day. And if you are having lower and more volatile performance, you will gravitate towards where private credit gives you predictability, right? It gives you strong absolute returns, and you get your money back on a quarterly basis and in 7 years rather than 12, 14 years. Lastly, the LP demands private credit. Mm-hmm. For what we will call the 6 wonders of private credit, your absolute returns, your quarterly income, your predictable outcomes, your downside protection, your ability to diversify through 26 sub-strategies of private credit, and you have that shorter duration funds. So the wonders of private credit will make sure that LPs will gravitate increasingly from private equity, from fixed income into private credit. And that is going to give us a very, very exciting growth over the next 2 decades.
That is so fascinating and tremendous. And I think all of our listeners will want to rewind the last 2 minutes of what you just said to listen again, because there's nobody that articulates this better than you, Jess. And I encourage all the listeners to go to Briarcliffe Credit Partners website, look at all of the great content that you put out. You're, really a great teacher and educator in the space, and I really appreciate all the work that you're doing to help to educate our clients and prospects and companies and investors globally about this asset class, which is, as you mentioned, one of the fastest growing, if not the fastest growing. And as one of our investors put it to me recently, is taking over everything. So Jess Larsen, founder and CEO of Briarcliffe Credit Partners, thank you so much for joining us on Private Capital Call.
Thank you so much.